It's really my fucking name. Like, like I insist. Like, I like it. I hate mosh pits, I think it's a dumb concept. And like all big fat guys, they get pushed up in. Dude, I don't want this fun. You're like, man, that's wrong. It's like music so much, I fucking hate each other.
All right, guys, let's see. Clayton? Pablo here. Val is excused. Michaela? Tom is excused. David Kelly? Piper? Maynard? Trayson? Peak here, and Rosie is excused today. All right. Oh. I'm trying to make it through the day. I was pretty sick last Thursday and Friday. Of course, I wasn't complaining. I ended up missing a whole day meeting on Friday. So it came right in time. Then I got 3 shots this Sunday. I mean, I'm not sick because of it, but, you know, all my body is aching. I got email about survey for only one of the groups. I'm waiting for the other 2 groups as well, then I'll give you guys feedback. Today I'm going to start talking about contingencies. And options in business plans, or in general, capital budgeting. As you know, we talked about projection of cash flows. And use those cash flows to calculate investment criteria. And make decisions. All the inputs that go into such calculations are themselves, and I'm going to use the term loosely, forecasts. So based on some sort of marketing survey and some other means, you estimate that you'll be able to sell, let's say, $10 million worth of stuff, and this could grow by a certain amount. It's going to cost you a certain amount of money. You're going to project costs in terms of both production costs, fixed costs, depreciation, you know, taxes, and all sorts of other stuff. Since forecasts by themselves are uncertain, we need to think about what to do in case these forecasts are not what we believe they will be. You know, example, suppose you believe that you could sell 10 million worth of goods every year, and assume that production costs are 60% of sales, hence 40% gross margin. For the sake of simplicity, we will assume that period zero costs are, let's see, 20 million. Project has a life of 5 years. No salvage to speak of. And you can depreciate period zero costs to zero in 5 years with straight line depreciation. Obviously, life is never that simple, but in order to highlight the role of uncertainty, I'm going to work on a simple scenario. So let's calculate, based on these forecasts, what would be the net present value of this project. So, initial cost. Let's assume a tax rate of 22%, which is kind of the current corporate rate. So years 1, 2, so gross profit, annual sales fixed times gross margin, and let me make these into money format. Okay. Depreciation is simple. Take the initial cost, multiply it with, or divide it with project life. Net income is gross profit minus depreciation. Well, technically I'm going to multiply it with taxes, but that's not going to make any difference. Come on. So if I change, for example, gross margin, obviously there would be a difference. And calculate OCF, net income plus depreciation. And let me shift these, because I also need year 0. Or let's just go ahead and calculate cash flow from assets. First year is negative 20 million. And after that, in this simple scenario, just operating cash flow. Remember, what you want to call, we assume that there is nothing with net capital spending, no salvage cost. So it's simple. So if we calculated NPV, oh, I also need discount rate. Well, cost of capital, let's assume 10%. I'm going to use the NPV function.